Welcome to this deep dive. Today we're getting into a book that, well, it's really shaped a lot of conversations around personal finance.
Oh, absolutely. Robert Kiyosaki's Rich Dad, Poor Dad.
Yeah.
A classic, really.
Yeah, and it definitely pushes back against some conventional ideas about money and careers.
Does. At its core, Rich Dad, Poor Dad really highlights this fundamental split in how people think about finance.
Exactly. So what we want to do today is unpack those key lessons, the insights Kiyosaki shares from his two dads.
Make it clear and maybe spark some of those aha moments for you listening.
Right. Give you some actionable stuff to think about when it comes to building wealth. Okay, so Kiyosaki starts with this really strong contrast.
The two dads.
Yeah, his actual dad, who was highly educated but financially struggled, the poor dad.
And then his friend's dad, the entrepreneur, the rich dad.
And the advice they gave was just worlds apart, wasn't it?
Completely. The poor dad, followed that traditional script.
Yeah.
Study hard, get good grades, find a secure job with good benefits.
Which sounds sensible. It's what most of us hear.
Very common, very understandable. But the rich dad, his focus was totally different.
He was all about learning how money actually works.
Yeah, the mechanics of it, how to make money work for you so you're not just working for a paycheck. A big shift in perspective.
Kiyosaki tells that story early on about working for his rich dad for like 10 cents an hour.
Right, him and his friend Mike. And it sounds exploitative at first glance.
Totally. 10 cents.
But it was a deliberate lesson. Rich Dad wanted them to feel what it was like working hard for very little money.
To feel that frustration.
Exactly. That feeling, that bit of anger, that desire for more. Rich Dad saw that as fuel, a motivator to learn a different way.
Not just passively accept the low wage.
Right. He wanted to show them that just trading your time for dollars, well, maybe that wasn't the ultimate path to freedom.
And this ties into what Rich Dad said about fear, doesn't it?
Oh, massively. He believed fear is the main thing driving most people's financial lives.
Fear of what, specifically?
Fear of not having enough money, fear of not paying the bills, getting fired, being in debt, all that anxiety.
And that fear keeps people stuck.
It keeps them locked in the cycle, the rat race, as he calls it, working for money primarily out of that fear.
So what's the Rich Dad's alternative? The way out of that fear-driven cycle?
It's about flipping the script entirely. Instead of working for money, you focus on having money work for you.
How? By acquiring things that generate income.
Precisely. Acquiring assets,
Mm-hmm.
things that put money in your pocket, which gives you security that isn't just tied to your job.
Kiyosaki also makes this point, which I think is crucial, that just earning more money doesn't automatically fix things.
Yeah, he uses his own poor dad as the prime example. Highly educated, good government job, earned a decent salary.
But still struggled financially. Why was that?
Because, according to Kiyosaki, without financial literacy, without understanding how money works, assets, liabilities, cash flow, more income often just means
More spending, bigger liabilities.
it's
Yeah.
exactly more debt, maybe a bigger house payment, a fancier car payment. The problems don't go away, they just scale up. It's not how much you earn, it's what you keep and what you do with it.
Which really highlights that learning how to make money work for you is like a completely different education.
Totally separate from traditional schooling, which mostly teaches you how to be a good employee, not necessarily a wealth builder.
So it's about understanding the language of money itself.
You got it.
Huh.
And that leads us straight into his first big lesson, which is kind of designed to shock people a bit.
Which is?
The rich don't work for money.
Okay, that sounds provocative. Let's unpack that. If they're not working for a salary in the traditional sense, what are they doing?
Their primary focus, their goal, is acquiring assets, things that generate income streams.
Okay, assets, like what?
Businesses that can run without them being there 24/7, real estate that pays rent, stocks, bonds, intellectual property, things that put money in their pocket.
And he uses that comic book library example from his childhood, right?
Yes.
Yeah, that's a perfect, simple illustration. He and Mike went from working for the 10 cents an hour
Yes.
to seeing those discarded comics as an opportunity.
Right. They created a little business, a library, hired Mike's sister to run it, charged kids admission.
And suddenly, those comics became an asset.
Exactly. They were generating income for them even when they weren't physically working in the library. Money was working for them.
They built a system, not just traded time for cash.
That's the core principle. And this really underlines why Kiyosaki is so big on financial literacy. Why is understanding this stuff so critical?
Because our schools generally don't teach it.
Largely, no. We learn professional skills, how to do a job, but not necessarily how to manage money effectively or build actual wealth.
He has that analogy, building the Empire State Building versus a house.
Yeah, you need a really strong, deep foundation, this is your financial knowledge, if you want to build something substantial and lasting, like real wealth.
Otherwise, you're building on, what did he call it, a 6-inch slab? Something like that, yeah. Trying to build big financial success without the fundamental understanding. Shake.
So how did his rich dad teach these concepts? Because finance can seem intimidating.
He kept it super simple. Used pictures, diagrams, basic drawings to show how money flows. Really demystified basic accounting.
Which brings us to those two really critical definitions. Assets and liabilities. Can you break those down Kiyosaki style?
Dead simple. An asset puts money in your pocket.
Okay, generates income.
A liability takes money out of your pocket.
An expense. Got it. Seems easy enough.
It sounds simple, but this is where Kiyosaki says most people, especially the poor and middle class, get tripped up.
How so? Like with the house example.
Exactly. People buy a house, often their biggest purchase, and think, this is my main asset.
But is it?
Well, Kiyosaki argues that if you have a big mortgage payment, property taxes, insurance, maintenance, that house is taking money out of your pocket every month.
So in his definition, it's actually a liability, not an asset, at least until it's paid off and maybe generating rent.
Precisely. It's about the cash flow direction. The rich, he says, focus on buying true assets, first things that generate positive cash flow. Businesses, rental properties, dividend stocks.
While the poor and middle class tend to acquire liabilities they think are assets, like the house, new cars.
Right. Things that consume income rather than produce it. And telling the difference requires that financial literacy. You need to understand the numbers.
You need to read a financial statement, basically,
Yeah.
even a simple personal one.
Yeah, understand income, expenses, assets, liabilities. Without that, you're flying blind. Okay, let's shift gears a bit. Taxes and corporations.
Ah, taxes. Everyone's favorite topic. What's the rich dad, poor dad take here?
Well, Kiyosaki gives a quick history lesson, pointing out that income taxes, in places like England and the US, were originally meant for the rich.
But they ended up hitting everyone else harder over time.
Pretty much, yeah.
Yeah.
Especially the middle class. But the key thing he contrasts is the incentive structure.
How so? For employees versus business owners.
Right. As an employee, you earn money, get taxed on it first, and then spend what's left.
The standard way.
But for business owners, especially those using corporations, the sequence can be different.
This is where the corporation comes in as a tool.
Exactly. Kiyosaki sees the corporation, when used smartly, as a major advantage for building wealth.
What are the main benefits he points out?
Two big ones. First, taxes. A corporation earns money, then it spends money on legitimate business expenses.
Like salaries, supplies, maybe travel for business meetings.
Right, and then it pays taxes on whatever profit is left over.
So expenses come out before tax, not after.
That's the key difference. Earn, spend, then tax. Compare that to the employee. Earn, tax, then spend. It allows for pre-tax spending on things that help the business.
Okay, that's a significant structural difference. What's the second advantage?
Legal protection. Using corporations and trusts, the wealthy can often separate their personal assets from their business assets.
So if the business gets sued, their personal house or savings might be protected.
Generally, yeah. They control assets through these entities, rather than owning everything directly in their personal name. Kiyosaki argues this offers a layer of protection that most people don't have.
So it's about smart structuring for both tax efficiency and risk management. Interesting. Now, what about this idea? The rich invent money. Sounds a bit, magical.
Yeah, it does sound out there. But he doesn't mean counterfeiting.
Good to know.
What he means is that financial intelligence allows you to create opportunities, to structure deals, to leverage resources in ways that generate wealth, sometimes seemingly out of thin air.
It's about creativity and seeing value where others don't.
Exactly. He brings back that idea that money isn't real in a fixed sense. It's based on agreement, on confidence, and the most powerful asset you have,
Your mind.
your mind. Trained financially, it can spot opportunities and literally invent money by creating value or structuring a clever deal.
He used that Phoenix real estate example, right, during a downturn.
Yeah, early 90s market crash. Everyone else is panicking, seeing losses. Kiyosaki saw
It's
opportunity.
only low.
Buying very low, finding distressed properties, bankruptcy sales, foreclosures, and importantly, structuring deals where he didn't need much of his own cash.
Creative financing.
Right. He tells one story about buying a property for, say, $20,000, using very little down, maybe seller financing, and quickly reselling it for $60,000, but taking back a $40,000 promissory note from the new buyer.
So he didn't get all cash, but he created a note receivable.
Exactly. He invented $40,000 in the form of that note, which was an asset paying him interest, maybe 10%. He created an income stream through deal making.
So it's about financial intelligence, finding the deal, structuring it, not just having a pile of cash to start with.
That's the essence of it. It's proactive, creative investing versus the passive approach of just working, paying taxes, and trying to save a little.
He makes a distinction between two types of investors too, doesn't he?
Yeah, type 1 buys packaged investments, mutual funds, stocks through a broker, REITs maybe.
Yeah.
Relatively passive.
And type 2.
Type 2 investors create the investments. They're the ones putting the deals together, finding the undervalued property, starting the business, structuring the notes.
And he encourages people to aim to be type 2 investors.
Definitely. And he says you need 3 key skills for that.
Which are?
1, finding opportunities others miss. 2, raising money, knowing how to finance deals. And 3, organizing smart people, building a team to execute.
So it's knowledge plus action plus people skills. Okay, the final lesson. Work to learn, don't work for money. This one also feels counterintuitive.
It really does. We're taught work is about the paycheck, the benefits, climbing the ladder for more money.
So what's Kiyosaki getting at here?
He argues that especially early in your career, the skills you gain are way more valuable long-term than the immediate salary. Learning should be the priority over earning initially.
He tells that story about the journalist.
Right. She wanted to be a best-selling author, brilliant writer, but was insulted when someone suggested she learn sales. Why sales? Because, as Kiyosaki points out, the term is best-selling author, not just best writing author. You need to know how to sell yourself, your book, your ideas.
So it's about acquiring a broader range of skills, not just being specialized.
Yes. Skills that contribute to your overall financial intelligence and ability to build assets, even if the job itself doesn't pay the most right now.
He used his own career path as an example, didn't he?
Yeah, leaving a potentially secure job at Standard Oil to join the Marines.
Hmm.
Why? To learn leadership.
Okay, that makes sense. Skills over immediate pay.
Then later, taking a sales job in Xerox, even though he's shy. Why? To learn sales, overcome that fear of rejection. Invaluable skills for any entrepreneur.
So what management skills does he specifically highlight as crucial?
He boils it down to 3 main ones: managing cash flow, managing systems, and managing people.
The core of running any business, really.
Absolutely. And alongside those, crucial specialized skills like sales and marketing. You have to be able to sell.
And communication skills too, right?
Definitely. Writing, speaking, negotiating. Being able to communicate effectively and handle rejection are vital.
So the advice is, look at jobs not just for the paycheck, but for the skills and experience you can gain that will help you build your own assets later on.
That's the long-term perspective. Okay, so we've covered a lot of ground from Rich Dad, Poor Dad. As we wrap up, what are the really key takeaways or first steps for listeners?
What should people focus on if they want to apply these ideas?
First, Kiyosaki says you need a strong why, a deep emotional reason why you want financial freedom. That's your motivation when things get tough.
Because it's not easy, right?
No, it takes effort and persistence. He also stresses that your financial future, rich, poor, or middle class, is largely determined by your daily choices. Small decisions add up.
And investing in yourself is key.
Hugely. Prioritize financial education. Read books like this one, attend seminars, listen to audio programs, continuously learn.
And don't be afraid to make mistakes.
View mistakes as learning opportunities. Everyone makes them. The key is to learn and adjust. Also, that principle of pay yourself first.
Meaning invest in your assets before you pay all your bills and expenses.
Yes, make building your asset column the priority. It takes discipline.
What about the people you associate with?
Choose your friends carefully. Learn from people who are already successful financially. And pay your advisors well. Good brokers, accountants, attorneys. They can bring you valuable deals and advice.
He also mentioned being an Indian giver with investments. What's that about?
Yeah, the term's a bit dated, but the concept is getting your initial capital back out of an investment as quickly as possible to reduce your risk.
Okay, and finding heroes or role models?
Yeah, learning from the successes and failures of people like Warren Buffett or others you admire in finance. And finally, teach others. Teaching reinforces your own learning.
He also breaks down income types.
Right. Ordinary earned income, your job salary taxed highest, portfolio income stocks, bonds, taxed generally lower, and passive income from assets like real estate, or businesses that don't require constant effort, often taxed the lowest.
And the goal is more passive income.
That's the key to escaping the rat race, according to Kiyosaki. Ultimately, the book's message comes back to mindset.
It's what's in your head that counts.
Exactly. Money is just an idea. Financial intelligence is your greatest asset.
And some really practical first steps from the book.
Yeah, simple ones. Start by tracking your income and expenses. Just know where your money is going.
Awareness is the first step.
And then, before you buy something, ask that question. Is this an asset or a liability? Will it put money in my pocket or take it out?
That simple question can change spending habits.
Absolutely. And finally, make it a conscious goal to start building or acquiring assets that generate passive income, even if you start small.
Fantastic summary. We really hope this deep dive into Rich Dad, Poor Dad has given you some valuable things to chew on.
Yeah, hopefully it sparks some curiosity and maybe a different way of looking at money and wealth building.
Remember, like we said, it's a journey. It starts with education, with shifting that mindset.
So keep learning, keep exploring these ideas, and think about those first steps you can take to make your money start working for you instead of the other way around.
Thanks so much for joining us on this deep dive.